Hello, everyone. This is Nicole Urbanik with OAUG, and I'd like to welcome you to today's webinar session. The Tax Management SIG did coordinate today's session, and we're going to have a panel discussion, so there'll be multiple speakers on. Before we get started, I have a couple of housekeeping items for you. The first is that all attendees will be on mute during the session, so if you experience any audio or technical difficulties, if you could send a message through the chat window that's on your screen, those will come to me and I'll be able to assist with those. We are going to have Q&A during the session as well as at the end. So as questions arise during the discussion, please feel free to send those through. There's a question window on your screen, so you can type those in and send those to me, and we'll share those with the group and have the panelists respond. We are recording the session, and we'll make this link available through the Tax Management SIG website, so you'll be able to review this later or share it with colleagues. And at this time, I'd like to go ahead and turn it over to Alex Fattini. He is the coordinator for the Tax Management SIG. Alex?
Thank you. Good morning, everybody. Today's focus is going to be on looking at local compliance issues around multinationals with respect to movement of goods. And we're kind of going to focus a little bit on the intercompany aspect of this because there's a lot of issues in this area. And so we've got a short agenda item because there are some scenarios here that we want to cover, and we'd like the panelists to weigh in on each one of these. So the first thing I'm going to do is introduce the panelists. And then we're going to have three topics covered, all to do with multinational supply chain, looking at intra-EU and then intercompany, then the intra-EU with a movement that might affect intercompany or might not, and then look at the EU non-member state transactions. So generally, we're kind of focused in what happens when you bring a supply in from another country and into the EU area, whether you're importing or moving through or exporting from the EU out into nearby states. So this is the idea, and I'd just like to introduce the panelists then before we start. We have three panelists and myself. I'm acting as moderator here. So I'd like to get to Hans Kogel, first of all, from Cilantro Systems. He's a multinational SIG chair and has done a first-class job in raising awareness of the issues that we'll talk about today. Rene Rombel, who is with Cilantro Systems as well, and he has a lot of experience in EU multinational movement and trading. And Andrew Benet with eBiz Answers. He's our EV Tax SIG EU chair, and I'll be working very hard in education there, and myself as SIG chair and moderator. So without further ado, I'd like each one of them to pick up a couple of words about themselves. Hans, please.
Hi. Hi, Alex. This is Hans Colby. I am a partner at Cilantro Systems in San Francisco, and I am the chairperson of the Multinational Special Interest Group. And I thank Alex and the Tax Special Interest Group for this chance to discuss some of the transaction tax challenges that come up when you deal with the multinational supply chain. We had some discussions how to structure it and what we should concentrate on, and we decided that it might be really useful to concentrate on tax in an international supply chain. Oftentimes we discuss tax on a country-by-country basis, and this is one of the few times that I know where we actually were invited and able to discuss tax on a global basis, where you go from country to country, and this is the situation that we do face if we are a global company and have to use Oracle to manage the supply chain. As you can see here, are you looking at the same slide? I cannot see the slide presentation actually, so I'm looking at a copy of the slide, and I'm looking at supply chain
right now. Yeah.
Case A.
We haven't got there yet, Hans.
Okay,
Ryan,
sorry.
would you like to take a couple of minutes?
I can back up, I'm sorry.
Renee, would you like to introduce yourself?
Yeah.
Renee?
Thank
okay.
you, Alex, for the introduction.
Yeah.
Renee.
Andrew, would you like to introduce yourself briefly?
Yeah, hi. This is I'm a panelist virgin. This is my first session, so forgive me of any mistakes I may make. I've been working now with Oracle about 15 years, 7 of those with R12, and I was lucky enough, or unfortunate enough, to be on one of the first European projects. And as a result, one of the first European projects doing the Release 12 rollout. And as a result, I was introduced to the tax module very early on. And the relationship has stayed to the point where now that's all I specialize in. I do have the advantage of having a lot of experience with all the financials, inventory, procurement modules, etc., which really give me a good balance into how to determine a tax solution. So I'm looking forward to answering questions, and I'll hand it back over to you, Alex.
Thank you. Renee Rumbel, are you there?
Yes, he is there. Here we go.
Yes, thank you, Alex.
Yeah,
Yeah, I'm René Rambel. I'm part of the European multinational SIG, and actually in the situation I'm doing Oracle now for around 15 years, and I'm in contact with Release 12 for 3 years. And in that situation, to solve multinational issues, I came in contact with EBTeX, and yeah, that's where I joined this meeting. Thank you.
thank you. My name is Alex Fattini. I've been doing Oracle ERP since 1991, so in excess of 22 years. My focus has been on tax recently, but before that I was with Oracle itself as a director of development, and was one of the architects of Oracle e-business tax. So let's move on to the scenarios. I think this is really what we want to do. So I'd just like to talk briefly about the panelist approach. What I'd like to be able to do is just, as a moderator, introduce the topic very briefly. I'm going to have Hans, though, describe the transaction. He and Renee will probably bring it out. And then once we've got that clear, then I'd like each of the panelists to have a minute or so to talk about it and give their opinion of what approach they might take to solve that. And then a wrap up, and as I said, we're going to have, or as Nicole said earlier, we're going to have some questions. So we've decided we're going to pick one question at the end. So I'm going to kind of rely on Nicole to choose that question, and it should be topical to the particular transaction we're discussing at the time. So without further ado, let's go to the first one. So this is called Multinational Supply Chain Case A, factory in Malaysia, distribution warehouses in Netherlands, goods owned by a Swiss company. The selling company is Germany, and the customer is in Germany. So Hans, would you like to introduce this case for me?
Yeah, we tried to pick overall the three cases. The three cases are really very closely related. And we picked a scenario of more or less a high-tech manufacturer. Let's take Texas Instruments, let's take a Hewlett-Packard, any one of those, a manufacturing country, a distribution center, and then a customer location. And a lot of these global companies have multiple companies then involved. And oftentimes they have what we have here, a selling company, and we have a distribution company actually, and then we have a factory, and all of these are owned by the same global multinational company. And so we have three different regimes, or three different tax laws, basically. Malaysia, Netherlands, and Germany each have tax laws. Each have, all of them have VAT. There's no sales tax country in here. And we tried to put in here what in our first glance, what our tax would be. From Malaysia, it would be an export. In the Netherlands, it would be an import. Shipping from the Netherlands would be an output, and since it goes within the European Union, it would be zero rated. And then in Germany, again, you have an input and you have an output, and it would come in with a zero, with an offset, and the sale would be a domestic VAT. That was our attempt here to say it quickly, just in identifying 3 countries and their VAT rules.
So in terms of how we address this, who would like to go first? I think if I'd like to bring Andrew Bonnet in first, just to kind of give his perspective of this transaction.
Yeah, hi guys. Yeah, as Hans has pointed out, we've gone with 3 scenarios, and this is the first of the 3, with the constant factor being the the original Malaysian factory, with those products then being imported into Europe and housed in a Netherlands warehouse, and then the intercompany entities are then drop shipping from that particular location. I think one thing to note here is that we're assuming that the product is being imported into the Netherlands and cleared for customs, but there are situations where you may not have the ability, or indeed your entity may not want to clear those items and pay the customs tax, and they may want to keep them in a bonded state. So there are additional complexities that we're not going to cover with this particular scenario, but that is another situation that can happen where the products that you're selling can actually be sold in a bonded state, and therefore the end customer would actually have to custom clear them. But I think it's very straightforward, this process. Malaysia, I think currently is, I'm not sure if it's actually moved to a GST-based tax, but it has a very similar tax solution around VAT. And as Hans has pointed out on this slide, it's a zero-rated export tax in effect. When the Netherlands then imports that, in reality there is no tax on the invoice. But what we like to do is to record a tax rate when that transaction is created, which is an import tax, which is a 0%. And then later on you would actually receive an invoice from your from the customs authorities or from your carrier, which would actually have the customs duty on. So that is something that needs to be clear here, that the import or the input tax is actually a zero-rated one. Because it's a sale of goods, the actual sale between the Netherlands and Germany is a zero-rated tax, and I think it's important to identify that it is a sale of goods, so that you can then link that with your Intrastat reporting at a later date. And then when it comes into Germany, to your selling entity, the reverse charge offset tax is calculated. So the net result is 0. However, there are cases, depending on your selling entity, where you may not actually be able to recover the VAT. So in that situation, you may have an invoice coming in that has no VAT on it, i.e. it's a 0 rated from Europe, but you may then therefore be liable for that offset tax. So that's something else that some of you may have issues with. And then of course the final transaction is between 2 German entities, and therefore the tax is a German domestic tax.
Okay, so I'm going to ask Rene to jump in and give his perspective on the transaction. Rene?
Okay, so I just want to mention here there are a couple of things that, in addition to Andrew, the first thing is from a point of view, from Oracle point of view, what we call the relationship in Oracle between Malaysia and Netherlands would be something like a replenishment transaction or a planning transaction. So that's actually where we replenish the Netherlands warehouse. And when we come, because the goods are then shipped from the Netherlands directly to the customer in Germany in this case, we thought here about a direct delivery from the Netherlands distribution warehouse to the Germany customers, but have intercompany transaction between the Netherlands and Germany. Regarding, and that's another complication you might have in some companies, is if you have in Germany the EU offset 19% and plus minus 19%. Some companies deal with products which are standard rated and reduced rated. So in addition to that, you might have situations in the company which you need to split the input with depending on the product type, which is another complexity on that which you can have. And the text, and you will have the same on the output text in Germany, where you might have different product types which could include 19%, and in Germany it's 7%. So that's just as addition.
Okay, thank you very much, Renee.
Yeah, just to add a point to that, actually, sorry guys, that's a really good point that Renee's made, because quite often when you receive that invoice, say from the Netherlands in this situation, the Netherlands tax it could be completely different in terms of whether an item should be reduced or exempt. And therefore, when it comes into Germany, it's only really the German users that are going to know whether that particular purchase is of a reduced rate tax. And instead of the offset being a plus and a minus 19%, it would be a plus and a minus 7%, which is the reduced rate tax in Germany. And a lot of companies don't bother doing that. They completely forget that, or the solution is automated. And unless they've got the items linked with a classification to drive that tax code, there's no real way of the system being able to know that it should have been a reduced rate plus or minus 7%.
Good. Thank you.
When we prepared this, this is Hans, when we prepared this case, we were trying to make the first variation of this case A, that you can resolve it with standard Oracle. And you can. And however, there's a lot of assumptions in the background, and I think that's what we were going through. A lot of assumptions that you need to validate, like the item type, like is it reduced tax, is it in a free, is it in the customs free zone, how do you make the documents right? There's a lot of assumptions in the background. I think we are trying to do two things here. One is just to alert everybody to the questions that we need to ask before we say this is all standard Oracle. And then second, what the possible solutions are. And in our group, we normally really value the questions to be asked, so we don't jump to conclusions too quickly.
Thank you, Hans. Just as a wrap-up on this one, I'd say that what we're looking at then is, I think I'm hearing everybody say, this is not an irresolvable solution. This can be solved through standard functionality.
Yes, it can.
Good.
Assuming,
so I'm
1, 2, 3, 4, 5, it can, yes.
Yeah. So what I'm going to do is move on to the next, unless there's a question on this one, Nicole?
We do not have any questions yet.
Okay, so let's move on to case B. I think it becomes a little more interesting in this case. Once I can actually touch it. There we are, case B. So Hans, would you like to introduce this one?
Yes, so the only thing that really here changes is that the customer is in Austria. The 3 companies involved are the same, the factory in Malaysia, the Netherlands is the distribution warehouse. The customer is in Austria and not in Germany. So now I have a situation that there's no domestic VAT in any country, or is no domestic VAT in the selling country. And in fact, now the question would be, at which point is VAT going to be collected? We're assuming that this customer here is VAT registered, so the German company does not have to charge VAT. And I think you see the problem right now will be that the Dutch company will pay, if it's not in the duty-free zone, they will pay VAT, but they cannot charge back VAT anywhere. So they have to go through a process of reclaiming VAT from the government somehow, because they're selling without VAT, but they're buying with VAT. So there's a problem in the Netherlands. But I think still the Oracle problem, and Renee can speak to that maybe, is going to be on the German VAT, on the Dutch side and on the German side. How do I determine my VAT code on the German side? So maybe you want to speak about that, Renee.
It's Renee?
Yes. So the first is the interesting cases here as well, that on the German side we have a triangulation case in Germany, which is simplification. And I think in this case, because we actually, I think we mismatched it. This will be in the next case where we come into the issues that we have different taxes between Netherlands and Germany. But in this case, it's actually a EU triangulation on the German output side, so we need to figure out in which country in Germany Germany delivers. And in conclusion with the next case, we see that depending on where the customer sits, our intercompany transaction can change in the tax impact. So that's actually what we want to see here.
Which is still standard Oracle.
Yeah, I think yes, this should be still standard. Maybe Andrew, you can
Yeah.
answer that actually a little bit more in detail.
Yeah, this is definitely handled by standard Oracle. The triangulation case is generally from a simplistic term, and of course we're making assumptions here without introducing complications. But the ship from and the ship to is within Europe, but the ship from and the ship to is not in the country where you're selling from. So in this situation, if the ship from is Europe but not Germany, and the ship to is Europe but not Germany, which is the case here, then it's a triangulation tax. The actual tax itself, and it's fully, you can fully automate this, and it's a very simple rule, but it is based on the fact that you are using the tax rules. So if you're looking to do an 11i to R12 upgrade and stick with your existing 11i solution, which is your direct tax rate determination STCC solution, then I'm not sure how easy it is to do. But with the triangulation, you always, and the same with any tax, you always calculate the tax based on your ship to. And if there is no ship to value, then we use the bill to. And this is particularly apparent with the next slide we're going to come to. But in this situation, if we were to look at this on the Oracle screens, the selling org, which is the German org, is going to have the bill to and the ship to customer. It knows who the customer is, and it knows where the product's being shipped to. But under the Netherlands entity, when that invoice is created, the actual ship to entity is owned by a different operating unit. It's owned by the German operating unit, and therefore it is not available to the Dutch entity. So the only thing we have available in this situation is the bill to location. So your tax logic should always look at the ship to first, and only if the ship to is null do you then look at the bill to location. So in this situation, the bill to is Germany, which is Europe, and therefore, even though the final customer is in Austria, because it's a European sale, it's going to calculate the same tax, i.e. the Dutch tax calculated will be this EU zero-rated tax goods. So it doesn't matter whether it's Austria, Germany, France, the UK, Ireland, etc., the same tax will work. But that will be different. We will actually come on to the next slide, so when it isn't Europe, that will be different. But this can be handled by standard solution. I've not really had any problems with this on implementations I've done, standard triangulation tax.
Thank you, Andrew.
Let me just ask you one thing, Andrew. I understand why there's no problem with VAT, because VAT happens to be the same whether you sell to Austria or to Germany. But on the intra-stat, it does make a difference, right? This intra-community.
Yes, and in fact, when you
need
tax
to
rules
pay, you need to declare what country you're actually shipping to, and Oracle is not going to know.
No, well, in fact, well, the standard functionality allows you to create a tax reporting code, which is split between goods, services, and triangulation, and you can assign that reporting code to your 3 independent tax rates. So normally, when I set up a solution, I would have an EU sales goods, an EU sales services, and an EU triangulation, so 3 separate rates, because then I can assign the tax reporting code correctly to those values. When the European sales listing report is run, it will actually allow it between those 3. So you'll have goods, services, and the triangulation. So there is standard functionality that is available that will allow you to make that split, which will then obviously help with the intrastat reporting.
Okay.
Okay, that's good. Thank you. I think that from the point of view of these kinds of cases, what we're seeing is that so far we've been able to handle standard functionality fairly comfortably. Before we go on to the next case, though, I'm just going to check to see if there are any any questions yet, Nicole.
We still do not have any questions.
Okay. So I think what we'll do is we'll move to the third case, which is probably by far the most interesting, mainly because it provides you with some very interesting issues where there potentially may not be a full solution for the from Oracle. So Hans, would you like to introduce this one?
Yeah, what we did now is we moved. The reason that before it was so comfortable was that the warehouse and the end customer and the selling company were all within the European Union. And the European Union has made arrangements to synchronize their VAT tax regimes. So of the 4 companies involved, factory, distribution center, selling company, and customer, three of them were in the European Union. Now we're moving the customer out of the European Union to Norway. Similar things would occur if we move the distribution warehouse to Singapore. So as soon as you start moving 2 of these 4 outside of the European Union, you're going to get some difficulty. So in this case, what we have is that the end customer is not in the European Union. It would hint at a scenario where you would try in the Netherlands in the warehouse. You now have a really bad situation. They're paying import tax and then they're exporting it again. So that's not a good situation, and you would probably try to talk to the tax director, or they should figure this out on their own, that this is not smart. Don't import it first and then export it again. But however, right now, let's just leave it like it is. But now in the German situation, they are selling something that never touches the country of Germany. It does not get imported, it doesn't move through, it just stays completely outside of Germany. So this is called out of scope. And now a few problems come up, and one of them is that the Oracle intercompany functionality assumes that the selling and the buying company in an intercompany transaction have the same tax code. It copies it over. And that's not working here, and maybe then they should talk more about, there are two issues here, and maybe you want to pick this up for me.
Yep, go ahead there. Renee?
Yeah. Actually, there, what we identified here, the one thing is, and Andrew already mentioned it in the Netherlands, if we compare it to the case we had just before, the Netherlands is actually selling in an intercompany transaction to Germany, and it doesn't know where the goods are going. But it needs to identify in the intercompany transactions if it's a Netherlands zero-rated export, or in the other case, it's an EU zero-rated tax code, and Netherlands would need to report based on the country of destination different tax rates. That's just the general first problem. And then only Germany needs to identify, even the invoice looks pretty similar there, getting from the Netherlands. One time it's an EU zero-rated export, but it suddenly needs, Germany needs to switch in the input tax for go to a deal out of scope. And then, okay, on the output tax, in the end, we at least we know, or Oracle knows at least, to which country it's shipping. So there we have a little bit less problems. So that makes this case much more interesting. And I think I would like to pass to Andrew now, which comments he has on this.
Okay, yeah, hi. I'll start on the AR side, which is the Netherlands selling to Germany. So the situation, as I explained before, is that we don't have a ship-to location. So whilst the system knows where the goods have to go to,
You mean on the intercompany we don't have a ship-to location, right?
That's right, from the Netherlands to Germany. Sorry, I apologize. From Netherlands, well, it's the transaction between Netherlands to Germany, where the ship-to is Norway, but that Norwegian address is not available for the tax engine to calculate the Dutch tax on the AR transaction. So in this situation, the ship-to is null, so the tax engine looks at the bill-to is Germany, and it wants to calculate an EU sales goods, which is wrong, because as we can see, it's been pointed out, the actual tax there is an export, it's an out of scope. So this solution, or this situation, cannot be handled by standard Oracle functionality. Now, in my experience, or what I've been able to develop, and the same solution I always use, the only way that I've been able to handle this is that you need to have a trigger point that when the AR transaction is being imported from order management into AR, it actually checks to see what the ship-to address is, because even though it's not available in the on the AR form for the operating unit, the actual value, it does exist. It exists with the German entity. And if you check the address, i.e. you have a look to see if the ship-to country is within the European Union, and it can do that by checking a predetermined tax zone called the European Union. If it is in there, it does nothing. If it's not in the European Union, then we can insert a value. This is the way I do it anyway. We can insert a value, whether it's a dummy tax code called non-EU in the tax classification code field, or an intended use field, or one of the user-defined fiscal classification code fields. And then we have tax rules that are actually looking for that value. So in this way, we're bypassing or using an additional field to tell the tax engine, this isn't Europe, even though the bill-to says, we're selling to Europe, it is actually a non-European sale, and therefore the tax engine can be intelligent enough to know this and then work out that it should be NL zero rate export. So
jump in for 1 second. You're saying Europe all the time. Don't do that. It's European Union. It's not in the European Union.
I apologize. Yeah, very important, because obviously Norway is in Europe and it's not part of the economic zone for the European Union. Apologies.
It's fine. I had one other comment, because there's a number. I mean, this issue has existed since Oracle came up with shipment-based intercompany transaction, which was, I believe, in 10.7. So that's like 15 years old. And so there's a long history of different solutions for this case. And what Andrew is talking about is probably one of the smartest ones. There is a number of other issues that need to get addressed that are not necessarily tax-related documents. You need to print documents in the Netherlands that have a ship-to address on them. So there's a number of things where people resolve it in different ways to do it at the same time. But Andrews is one. Andrews is one way that is specifically for the e-business tax. It's a common issue if you have a ship-to country that is different from your intercompany selling partner.
If I was to look at this transaction and look at a solution, I have nothing within the operating units that are across there, or I'm forced to structure the legal entities in a certain way to get this tax outcome? Or are you saying there's no solution and I have to use these dummy tax codes?
Say it one more time. Well, I could. In this case, the simple way would be to say the Dutch company is selling to Norway. I'm not having the German company sell to Norway. I mean, you could change the business. You could change the business flow not to have this tax issue.
Right, and some companies have done that, but they've done this kind of thing outside the product, right, with concessionaire and things like that. Or is this the same thing?
Well, see, if the shoe doesn't fit, you can change your foot, and that's what I'm talking about. You can change how the company operates. But there might be reasons that you need to do it this way. I mean, Norway, this is probably an outlying case. But you do have, I know from a lot of medical manufacturers, you can't just nilly-willy change the selling companies. there's a selling relationship that you need to abide by. And so there might be a lot of good reasons to do it like this. But normally you would try to avoid, for a number of reasons, you would try to avoid having this import-export in the Netherlands, and then you would try to avoid having a non-EU country being sold by an EU-based country because of, I mean, there's a number of other, reasons for that. But it does happen quite a bit, actually.
If I was to try and set up this as different operating units and legal entities, could I create internal transactions that would provide me with sufficient ship-to information to solve this problem? Andrew, Hans?
I don't think so. I spent a lot of time trying to resolve this issue.
Yeah.
I sort of worked it through with Oracle. Well, a colleague of yours, Patrick McBride, we tried to go through. We actually, what I was actually looking for was the ability to have a ship-to load, just the country code. So rather than actually bringing in the German operating unit's customer address, I was trying to push for just the value. Can we just have a field that says ship-to country, and then use that within the tax engine? And that was, they said there was a lot of complexity around trying to do anything like that, and it just wasn't possible. And we're going back 4 or 5 years now, and I believe that this particular issue has now been resolved in Fusion. But as far as I know, Alex, there's no standard functionality that allows you to do this. And the solution that I propose as well is it's a very simple one. You don't change any of the code in terms of the way the tax engine works. All you're doing is using a way of looking up a value, i.e. the fact that it's a non-European country, and then inserting a value in one of the fields that the tax engine can use.
Okay. So we've had that. I think that, are there any questions on this case before we move to, I think we have a slide that talks about this solution in terms of, some of the options. So, Nicole, any questions?
I think Renee wanted to
Oh, sorry, Renee. I can't hear Renee.
You're not on the mic.
Better now?
Yeah, speak up if you would.
Okay. I just want to add a solution possibility. Either you can try to have some situation. I've seen 2 solutions to this issue. The one thing is to really change in the invoice the tax code. The other one, what I have seen, which was also interesting, is you don't have too much customers, so you maybe have only one customer in Norway. Actually, to just change or add the ship-to address in the interface, because then you can use actually Oracle standard tax functionality, because then you have the missing information. The only thing is you need to import the ship-to address for the intercompany customer before you can actually use it in the outer invoice. So then you don't have, that's another, these 2 solutions I've seen here in Europe to resolve that issue. That's just as addition.
Okay. So if there are are there any questions?
Alex, sorry, just a quick, going to what Hans was mentioning earlier about the fact that when the Netherlands imports, it has to pay the import duties, and then it has to, if it then exports, it's not getting any VAT back. And if you're talking, huge numbers, that amount of VAT or tax can be quite a burden on any cash flow for any business. There's a couple of things. I know in France they have what's called the non-dom exemption, where they'll actually seek exemption certificates from all their suppliers, therefore apply them exempt when their sales are predominantly export. And I also know with a previous client in Hungary where they managed to get exemption certificate as well. And the exemption certificate was based on the final ship-to location. Because again, the Hungarian authorities were very reluctant to give any money back when the tax had been paid. So it caused a big burden on the client in terms of getting, with cash flow.
You can get these exemption certificates in any country. It's just, then you need to know when you import the goods that they're going to go out to Norway. So once you identify that, it's a lot easier. I think the assumption we have here is that it comes into the warehouse, and you don't know it's going to go to Norway. I mean, that's like a background assumption. If you know it's going to go to Norway, I think then you have a lot more options.
Yeah.
And I'm not saying this is a great, it's just this situation exists. We need to make sure that we identify the challenges about it. There's a number of different ways of resolving it. And, you know, I think what you're suggesting, Alex, to investigate, I tried once and I just gave up. I tried to set up different intercompany flows for these scenarios, and that is so much overhead that the solution that Andre suggests is a lot simpler, or what Renee suggests. You just pull in the final ship-to address to the intercompany invoice, then it's available on the printed document, and it's available for e-business tax.
Good. Okay. So I think what I'd like to do is move on to the solution slide, if you will, because it covers off, and we can have further discussion on some of the nuances of this. The point, I guess, in the solution is that we know we have some issues, that there are product gaps, there are ways to work around it, so it's not irresolvable, but we do have to face these challenges. So who'd like to pick this one up? You want to start with the transaction part of it, Renee?
Alex, I'm sorry to interrupt. We did get a question that I think has been general to the discussion, and we have one participant who's asked, how do you handle the excise tax? So I don't know where you'd like to bring that into the discussion.
Actually, yeah. Well, maybe who would like to kick that off? Andrew, perhaps, with the excise
sure.
tax?
The way I normally set it up is that I create separate tax rates, which I call, tax only. So this would be an NL VAT tax only standard or reduced rate, because you can import products that are actually charged at the reduced rate tax. This tax rate is set up as 100%, and you only use it for your duty taxes. And when that AP invoice comes in, from either the custom authorities or from your FedEx, DHL, you actually enter a tax-only line, and it's important you have to enter that line first. You don't enter any items. You enter it as a tax-only line first with the tax amount. You can then click the calculate tax. It will then give you the tax line, so it saves it in, and then if you need to add items afterwards, you can do that. But it's a good point, because it can cause a lot of confusion, particularly in countries like Italy, where there's some special tax rates linked to this. But it is quite easy to handle, because by doing it this way as well and not putting it to your normal VAT, i.e. your NL VAT standard tax rate, it means you can easily separate them out. And technically, your tax-only tax should match up with your import, your out-of-scope import base amount. I.e., so if you've imported €1,000 worth of product and the tax rate is 20%, then your tax-only amount should total up to 100. Obviously, with the timing differences, it's not an exact science, but it is quite a solution that I find no issues with in handling.
Can I just ask though, did you say excise tax, like tobacco tax, like gasoline, like that kind of thing, excise tax?
Yes, that's correct.
Okay, so this is not a
no, I was talking about
occurs on sale.
Sorry.
It's okay. So it's a tax that is done on consumption, basically, and it doesn't matter if you sell or not. There are different ways to handle it. I normally handle it similar to the duty, because you have to, normally the VAT is applied on the total value, which includes the excise tax. But there's a lot of different rules. Maybe we can ask back. Maybe it's a different discussion. It is not the same thing as what the e-business tax does with transaction tax. It can be rolled. I've done it a number of times to roll it into the e-business tax solution. Then you have to calculate tax on tax.
So
normally you just need it in the end country. You don't need it in the distribution places.
Let's start with talking about the Malaysia structure here. Is there anything specific about the Malaysian operating unit structure or the legal entity that has to be unique in order to get these things like the custom duty, the duty-free zone, frequent exporter set up properly so that you can get the tax to work?
I added these because I think the other two, Renee and Andrew, mainly deal with the European solution where it comes into, and I don't want to get in the middle. So this has to do with the warehouses where the production takes place. The advantage of setting up a customs duty-free zone or a duty-free zone for the factory is that the purchases that the factory makes can be transaction tax-free. We start with a scenario here where they have already produced it, but if you think about it logically, they have to get the materials somewhere for that, and they have to pay duty and import tax on those materials. You want to try to get out of that. So that's why many factories are in special enterprise zones in China and Malaysia and Singapore and so forth. That's really the main point. Otherwise, the export is very straightforward.
Good. Who would like to address the Netherlands solution area? Renee? You want to take it off?
Yeah, regarding the Netherlands, I made that the intercompany AFK, the PTEX code is actually public in the standard solution. I think Andrew wants to mention something that this is not always true. I just mentioned it here. Maybe Andrew, what you meant by?
Yeah, well, so generally, whenever the intercompany tax is calculated, whether it's AP or AR, it's done so completely independently of whatever tax was calculated in the AR side. So in the intercompany process, the AR invoice is created first, then the AP invoice is created. And if you set up a rules-based solution, then the tax rates are independently calculated, so there's no reliance on the tax being copied across. But I believe if you're using the SDCC-based solution, then I think there are times when you do actually pull through the old tax rate. I'm not 100% on that because I tend not to use the old rate solutions. I tend to try and set up new R12 fully automated rules-based solutions. So I think, Renee, I'll pass back to you if you can talk about your experience with those.
Are you saying in the shipment-based solution intercompany, that's what we thought we had here. So I have the Netherlands company is shipping to a customer of Germany. They make an AR invoice. Or in this case, oh yeah, this is the AP tax code. Yeah. You're saying that it does not copy necessarily the AR tax code over to the AP?
That's correct.
Which I didn't know.
Well, in reality, if you use a rule-based solution, your tax classification code, in effect, should never be populated. You should never need to use it because you're using your rules and the other determining factors to work out what the tax is. So when the AP invoice is created, it will pull the information from the item because the item, of course, is shared between both. So any classifications linked to those items will be pulled through. That means an item could have an exempt status on the AR side, but on the AP side, with a different country, there may be no exempt status. Also, it looks at the location, so where the ship from location is coming from, party classification code. So from what whenever I've set this solution up, I never have the AP tax code through with your standard intercompany process. For the Aegis transactions, it's slightly different.
Yeah, no, we're talking about shipment-based intercompany. Yeah. Okay.
So, yeah, what we're talking about.
Great. No, I appreciate it. I mean, I will give you a call when we need to.
Definitely, I know, actually, and that's the question. If there's no text populated in the interface, it goes through the standard AP invoice interface. It definitely, then the normal logic would be applied. What I don't know exactly in that was if it really, it doesn't copy anymore. But maybe somebody has an answer to that in private.
The Aegis intercompany right now still copies the tax ID over from AR to AP.
But that's AGIS. That's not necessarily the shipment-based.
Right. For the regular movement, the presentation of the invoice electronically between two operating units works differently.
Okay. Well, thank you guys. That's why we're doing presentations, to learn ourselves. Thank you.
So the reason for the aegis is that there is no ship to. There's nothing there that identifies things. So the presentation of the invoice is equivalent to saying, I am the seller and I tell you what I'm billing you. If you want to reject that invoice and tell me to rebill it because it has to be different, that you can do. And so that's the solution to get around the issue of the ship to. I think there are other good reasons to do it and other reasons not to do it. But there's no profile option that allows you to switch it on or off.
Okay.
Now, what about the tax recovery part and the reporting as a result of this? If you're using the movement part of the intercompany, are you left with any issues with respect to the solution in getting proper documentation built and be able to do the reclaims that I've just heard of several times here, especially the Netherlands reclaim?
If I can just jump in there, because this is something that I have often had to deal with. Yes, it is a tricky thing in any country to get tax back. In the Netherlands, it's probably one of the simpler ones. You would have to prove what you did, that these goods left the Netherlands. And you would have to prove that with shipping documents.
Okay.
So it is certainly better not to pay it and then wait for an audit than to have to prove everything. And so if you can't prove it, then the assumption is that it stayed in the Netherlands and you don't get the tax back.
Okay, good. So the last part, and we've only got a couple of minutes left, surprisingly, and that is the German side, the AP intercompany. Does anybody want to jump in on this part? Andrew, perhaps?
Well, as I said, the taxes are calculated independently of AP and AR, but I think the other thing to factor in here is that because they're intercompany and we're looking at inter-country as well, the tax rates tend to be zero rated anyway. It's very rare, certainly for an intercompany, that you would ever be charging a tax. So the actual tax rates are pretty much always zero. It's just how, they still needed to be accurate though, i.e. whether it's intercompany for goods or services, it needs to be split to match up with Intrastat reporting or other VAT reporting. So that's the only thing I've got there to add.
Okay, fair enough. I think at this point it's a couple of minutes left in the session. Nicole, do we have any questions? Right. So I'd like to just wrap up briefly. I think we've had a discussion of 3 cases on intercompany. Those 3 cases had to do in part with triangulation, with movements within the EU, into the EU trading community, and out to other European countries. All of those had complexities that we have a movement solution that can work in almost all circumstances. There are still gaps if you have to deal with things like AGIS. But nonetheless, the complexities can change your solution quite dramatically. And sometimes you have to look for a solution outside of the system, and, as Hans pointed out a couple of times, where perhaps you need to change the way in which you handle your trades in order to get a reasonable solution overall. And I'd like to thank Hans Colby of Cilantro Systems and René Rundell, Andrew Bonnet of eBusiness, and Nicole Urbanek for managing this process for us and allowing us to have a terrific time. I think that this always bears more discussion, and perhaps Andrew and I will discuss having something in the EU around this same subject at another time.
Alex, I'm so sorry. We did get one more question in, if we could address that with the group.
Sure.
And this, I think, is just a general question, not specific to any of the cases. But one of the attendees has asked, what about Incoterms? I am implementing EV tax using Incoterms to calculate the right VAT. Do you have any cases or experience?
Okay. Andrew, would you like to talk about that briefly?
Yeah, I don't believe there's any, you can't link the Incoterms to a determining factor. The only thing you can do is to have some sort of trigger that will use whatever the Incoterm you have, and then maybe copy that to the tax classification code field, for example, and use the actual tax classification code field can be used. You can create dummy tax codes, so you could replicate your Incoterms and then build the rules off those. But I think there's also situations where the Incoterms are not good enough. So, for example, if you've got an FOB free on board or something like that, and you're trying to say, well, I'm calculating the tax based on the locations. So it's I did look at this before when I was setting up a coal tax solution, and I had to drop it because there was too many holes in the situation. But you can use the Incoterms potentially to help, as long as you've got other determining factors such as the ship to locations, things like that, item classifications. But I think using just Incoterms is too, I'm trying to think the right word, it won't give you enough detail.
Yeah, Hans or...
Yeah, I just wanted to say, if it's really, there are situations where it is very important to tie it to the Incoterms, especially if you have, I mean, it comes up if you deal with commercial, if your customers are large businesses, and in some cases they want to do the importation themselves because they have an exemption for it, or they have an exemption to VAT, so you don't want to get the VAT. You know, they want to clear customs themselves. Let's say that you have a customer in Austria, and they don't want it to buy from the Netherlands, or they don't want it to first to get imported into the Netherlands. They have a duty-free warehouse at the Austrian airport in Vienna, and they want to buy from you, but they want the Incoterms that they pay, that they deal with the VAT and duty and so forth. You need to create a special location for that. That's what I've done. Create special locations that I can then drive the tax from. So the ship-to location, you have to adjust the ship-to location of this customer so you can drive the tax to be determined in these cases from the Incoterms.
So
that's work. You just need to do it. It's how, you know, you do it in special cases.
So Incoterms basically...
You can also use party classifications as well.
Where you take legal possession of the goods.
Exactly.
That would be the tax place of supply?
Yeah, you would have to define, let's say, Vienna Airport as a special place, and you have a ship-to location Vienna Airport, and you have that already for your goods coming out of Malaysia. It goes straight to the Vienna Airport.
Good. Well, thank you. Any other questions, Nicole?
Nope, that was the last question.
Great. Thanks to everybody. Nicole, any last words?
I want to thank everybody and all the panelists. This was quite a bit of, and I really appreciate this chance. This is the first time that I know that we discussed the global trade chain of tax codes here. Thank you.
I think it bears more discussion. It's a great subject, and it's endlessly...
It sure is. Thanks.
Great. Thanks, everybody. Nicole?
Bye.
All right, thank you, everybody, and we will make sure that the recording for this session is available through the Tax Management SIG website. So just allow a few days for that to be available, and thank you so much for attending.